Every day, chat and chart live during the New York session. Here, real traders share the raw truth, their mindset, technical analysis, and execution. This is where real traders show their skill set. Welcome to Trading TV. This is your stage to shine.
Hello, good morning. Good morning, everyone. Hello, guys, how are you? Good morning, please confirm that you can hear me. Hello. Do we have anyone? All right, so good morning, everyone, and welcome to a new episode of Chat and Chart. This is the London session. London session has opened 14 minutes ago, and now we're going to go through the weekly high impact news calendar and then move to the charts as always and see where we find alignments between the fundamentals and technicals. All right, so without further ado, let's get to it. We start with Monday. Today, we had the GDP coming from Japan. 1 second, this is already out. Let me check. Yeah, it came in line with expectations at 0.5%. So there is growth in the Japanese economy in the first quarter of the year. So this is considered to be positive for the Japanese economy. All right. So the previous was 0.3, actually not 0.5. The forecast is 0.5, and the actual came in at 0.5 as well. Okay, then that's it for today. We move to Tuesday. Just tomorrow, we have the existing home sales. There's an expectation of a slight improvement in existing home sales to 4.08 in comparison to 4.02 million existing home sales in the previous reading. So if it comes in higher, that's positive. It shows that people are still moving money within the US economy and real estate sector is doing well. If not, then the exact opposite. Okay. Then we move to Wednesday. Wednesday is going to be a busy day. We have the CPI coming from the US and the core CPI. And of course, CPI, we have the monthly number and the yearly number. Okay, so the monthly number is expected to be lower than the previous. The previous was 0.6%. The forecast is 0.3%. I doubt that it will be lower. Why? Because during the past period, we saw like very what's it called? Like there has been some serious disruptions in the oil supply chains, and there has been some serious hit to inflation around the world. If it's the US, if it's Europe, if it's UK, all major economies are suffering from the supply shock caused by the US-Iran war. Now, very recently, we saw yesterday that Iran started some attacks, or like they initiated some attacks against Israel, and because of that, even like the region is now unstable again. like for us here in Jordan, we started to hear sirens. Like the sirens started sounding after, I don't know, a month and a half after the ceasefire. So yesterday night was before the markets opened. We started to hear sirens again in Jordan, which means that the ceasefire could be over. And since they didn't achieve any progress in the negotiations and to reach a deal to end the war, I think now they're back on, and we saw this happen, and we saw the effect of this to the markets. We saw oil up 5% since market opened. We saw gold dropping heavily and like strongly below 4,300, and silver is around $66 per ounce, which is an 11-week low. Okay, so the CPI is expected to be lower, but I doubt, because the oil supply shock is going to be weighing on economies. The core CPI, which excludes energy and food, is expected to be higher. So, which means that it's not only that inflation, it's not only that energy is affecting inflation to the upside, but also the other components of the CPI are increasing in price. And if you want my opinion, I think it all boils down to energy, because if, for example, we're talking about any other component of the CPI, anything in the world needs energy for you to produce. And since everything in the world needs production or needs energy for its production, then the other components are going to be affected indirectly by high energy prices. Okay. Hello, Mr. Professor. How are you? Hi, hi, hi. Okay, and then we have the CPI, the yearly CPI, that does not exclude energy and food. It's expected to be around 4.2% in comparison to 3.8%. That's very, very high inflation. We're back above the 3.5 mark, which is like a very harmful number. It's almost double their target, even more than double, which is 2% inflation target. 4.2% is very, very high. So what does that mean? It means that the Fed is most likely going to keep rates higher for longer. If not, they're going to hike rates instead of cut rates. So we entered the year with the expectation and the optimism that the Fed will start to cut rates this year, and will continue to cut rates after the most recent cuts at the end of 2025. So there were expectations that the Fed is going to continue this cutting cycle, but since the war started, everything changed, and now cutting rates this year is off the table. Now markets are pricing in a possibility of 67% of a rate hike this year by December, I think. And the most important part of the month, or the most important data or event that is going to take place, is the FOMC meeting on June 17th. Why is this very important? Because this is going to be Kevin Warsh's first speech. This is the first time markets will be hearing him speak directly to them. So we will be watching, and traders will be watching for the tone very carefully. They want to see if he's going to give more forward guidance, less forward guidance. Is he going to be is the tone going to be hawkish? Is it going to be dovish? Is it going to be cautious? So that all depends on that meeting. That's why I'm telling you this is the most important event, maybe of the year. All right. So then we have the Bank of Canada interest rate decision. The previous is 2.25%. The forecast is also 2.25%, which is a no change. They're not expected to hike. They're not expected to cut. So if they surprise to the upside and decide that they want to hike rates 25 basis points to 2.5, this is going to be very positive for the Canadian dollar. If not, it's going to be expected, and we don't expect to see any high or any volatile moves. Okay. And then we have the crude oil inventories. This is, I think, the fourth or fifth consecutive week of negative readings on crude oil inventories. They're draining out fast at a record pace. The previous reading was minus almost 8 million barrels. So there is a shortage of 8 million barrels. They drew 8 million barrels out of their inventories. They didn't add, or whatever was added was taken out plus 8 million barrels. So the inventories are going down and they're draining at a record pace at this point. Then we have the 10-year note auction. That was a big jump to 4.468%. I expect to see even higher, maybe for above 4.5, almost 4.6%. So what does this do? If this is the case, if it goes up, it means that that's positive for the dollar, and it's negative for gold specifically. Why? Because gold is not a yielding asset, so it does not give you back any yields. People would, or investors would, move to less risky assets like the government bonds and the government notes and the government bills, so that they get a high return, which is almost 4.6%, flat on a yearly fixed, without having to deal with the volatility and the risk of a moving asset like gold. So that's why the higher the yields, the higher the rates on government notes and government securities in general, the more pressure we will see on gold. All right. So that's it for Wednesday. We move to Thursday. Thursday, we have the deposit facility rate and the interest rate decision from the ECB. They're expected to hike 25 basis points. So this becomes 2.25% in comparison to 2%. And the interest rate decision is expected to raise interest in the EU from 2.15% to 2.40%, which is a 25 basis point hike. Okay, and then we have the PPI coming from the US. Last reading was crazy. Like it was expected to be 0.6, 0.7, and it came at 1.4%. So now the forecast is that it's going to be or to go lower, but I doubt that is going to be the case. It's going to be much higher than this, given the supply chain disruptions and the oil supply shock. All right, 1 second, let me check here. Okay, all good. And then if this comes in higher, then that's positive for the dollar, and like it gives the Fed one more reason to hike rates. Good morning, Teklas University. Okay, and then we have the initial jobless claims, which came in at 225K or 225,000 jobless claims last week. If it comes in higher than this, then it starts to show that the jobs market is cracking. If not, because this was the first negative reading in initial jobless claims for the past 4 weeks. So if it comes in higher this week, it means that we are starting to see an uptrend in jobless claims, which can mean negativity for the jobs market, means that jobs market is starting to crack, and the Fed will be in a very tough position. Okay. Now, next we have the ECB press conference. So after the interest rate decision, we have the ECB press conference. We're going to watch for any different tones from the ECB. We're going to see if they're going to continue hiking rates, if they're going to just like hike this time and wait. So it all depends on what they say in the press conference. We're going to wait and see. Finally, we have Friday. We have the German CPI, which is expected to be as the previous, minus 0.2%. So it's expected to the German CPI is expected to go lower. So there's a disinflation happening in Germany and German economy, and this disinflation is also paired with a drop in the GDP and drop in growth. Then we have the UK GDP month over month. The previous was 0.3%. So if it comes in anything higher than this, then that's positive for the UK and the GBP. If it comes in lower, then it means that the war and the supply chain disruptions are weighing on the UK economy, as they should, if you ask me my opinion. Okay, so that's it for the economic calendar. Let's now move to the charts real quick and take a look on what's happening around us. The XY is above 100 now. 1 second, let me stop sharing this. And then we start a new share. All right. Samuel trying to share. Can you please help? Trying to share my screen. Hello, hello. All right, there it is. Okay. All right. So we, as always, we start with the DXY. We start with the monthly. So yeah, this monthly candle, the current monthly candle, has broken above the previous month's high, and now we're on the way to break a 2 month high around 100.3 or 30. If this gets broken, we have one more level, and that's a very, very important level, which is 100.7. If 100.7 gets broken and we stabilize above, we're going to start to see a big rally to the upside in the XY, as expected and as explained in previous live streams. Okay, so the weekly also, we had a very bullish candle here on the weekly. The last weekly candle was very bullish, and we are expecting to see higher highs this week. We go to the daily. The daily shows us the exact same. We might be accelerating here, so it might look something like this now. I mean, the trend and the slope of the trend might be accelerating and might be steepening. So let's wait and see. But for now, that's it. We're expecting to see a break above 100.7 and a stabilization above, because look how many times price tried to go above this and it got rejected. So I believe this time it's going to break it because of the overall situation in the world, and the very high inflation numbers that we're witnessing from the major economies, especially the US. Okay, so that's it for the XY. Let's now move to Euro, which should give us an exact opposite reading. So the monthly, 1 second, did it break? Not yet. So it broke last month's low, and it's on its way to break the 2 month low, which is below 1.15 cents. Okay, so 1.50. If we break below this and we stabilize up below 1.15, that's going to be a very negative sign for the euro. And now we move to the weekly. Weekly closed very, very bearish, in contrast with the DXY, which closed very, very bullish. So that's basically an inverse DXY chart. Okay, so the main number that we want, or the main level that we want to break, is 1.14. Once we break below 1.14, we're going to see much deeper negativity on the Euro USD. Okay, now we move to the daily. Okay, so let me tell you something. The daily, we might be retesting 1.1550 before starting the big drop. So that was a very bearish candle on the daily. So we will have to wait and see what's going to happen. But the next level is 1.14. So we have two levels. We have the 1.15. If it breaks, then the next level is going to be 1.14. If that one breaks, we're going to see a much sharper drop in Euro USD. Okay, let's take a look at the GBP. Okay, GBP also had a very tough day on Friday. Okay, so the monthly is not as bearish as the euro. It did not break last month's low yet, which is below 1.33. Okay, then we have the weekly that was pretty bearish. It broke below last week's or the previous week's low, and now we opened on a gap to the downside, breaking last week's low. So that looks very bearish to me. The daily also is very bearish, but we need to be closing below this level, which is 1.33. We need to close below it so that we can confirm the weakness in the GBP USD. We don't want to see just like a sweep and then a reversal to the upside. We want to see it like close below this level, which is 1.33. All right. Then we move to the Bitcoin real quick. Bitcoin is doing very well as per our analysis. We're still expecting it to go around 55, 53,000. If we reach there, we're going to see a huge increase to the upside. Okay, guys. So we're going to see this. And then what's happening on the weekly? Yeah, it still looks good. But one thing, like it might, like very low probability, like I'm talking like 20%. It might just reverse from here because why? Because we have the 200-day moving average, okay, in its way. So once we break below this and close below the 200-day moving average, we're going to see an easier drop toward the 55 level. So the low was 59. So it's very close to our target of $53,000. All right. Now let's go to everyone's favorite, gold. Okay, so gold, we had two scenarios that we drew like, I don't know, 3 months ago. It's either we continue to go up from 4,100, okay, to 6,000, or we reach here and then we start dropping toward 3,800, 3,600. So what I think is going to happen, and like what I see more likely to happen, is this scenario, the red scenario. So we reached this and we got rejected from 4,900, which is a very important point to the upside. That's the most important resistance we have in gold prices. And then we started to drop, and we dropped almost $600 from this point. And I'm expecting to continue to see negativity on gold all the way to 3,800 and 3,600, from which would be an amazing long opportunity, because if we reach here and then we go all the way to 6,000, that's going to be how many pips? That is going to be 22,000 pips. Imagine, like that's a monster trade. If good morning, Arif. That's going to be a monster trade if we manage to catch it somewhere around here and hold it all the way to 6,000. I would be like, I've been waiting for this for like since the beginning of the year. But if this happens, I'm going to like risk heavily on this one and protect myself all the way down to like below this area, which is like what 2,500. So it's almost one to one. It's as if I'm buying physical. So let's say I buy around 3,600 or 3,500. So I need to like protect myself 1,000 pips to the downside, not 1,000, 10,000 pips to the downside, and like buy with very low leverage. Okay, because let me show you how it would look like. Now, obviously, you can always like, for example, buy here, place your stop here, and go higher with the leverage. But I wouldn't do that. I want it to be below this area. Okay, and I'm targeting this. So that's a very high probability trade, very, very high probability trade, and it gives you 1 to 2. That's why you use low leverage on this one so that you can, like, your account can actually survive the major drops. And whenever you see a very, very big drop, you can easily buy and average down your price. So that's what I see about gold. I still think it's going down. And finally, silver, I think we're going to reach 55, 54. Once we reach that level, if we don't reverse from here, that's because that's the 200-day moving average, what I doubt. So I think we're going to reach 55, 53, 54. Once we reach that, I think we're going to see a very nice opportunity to long silver against the dollar. Okay, so that's pretty much it, guys. If you have any questions, I'll be more than happy to answer. So I'll give you a couple of more minutes to ask questions if you have, and then we call it a day, or not a day. We call it a session. Do you guys have any questions? Do you guys have any questions? Okay, what's going on with the Nasdaq? Look, what a very big drop. Look, on one of the live streams, I showed that this engulfing candle, bearish engulfing, could be the start of a big move, and obviously it has been the start of the very big move because we dropped from here to here, so that's almost what, from the all-time high to, so that's a 2,000 pip drop. Imagine that's a 2,000 point drop. That's very, very big. And look, we have an engulfing candle on the weekly. So the minimum that we're going to target is another 1,000 pips from here. The minimum. But it could be correcting, let me see. Could be correcting towards this area, which is 27,700, or most likely 26,000. So if we reach 26,000, because look, guys, this was a resistance, yeah? It got broken, and then we didn't see any serious retest of this level here. We didn't see any serious retest of this level. So what does this coincide with? The 126-day moving average, which is my favorite moving average. So I'm expecting to see this level be hit very soon, within like weeks. Okay. Okay. No, sir, no doubt. You're excellent. Thank you very much, Mr. Professor. You are also excellent. Thank you so much for the dedication. Thank you very much for joining and for watching. USD JPY again crossing. What's your view on that? I think like I don't know if you were here like the last time. I was talking to Suham about it, Pearson Hardman. I was telling him that like this is a very important level and it got rejected from it. So I expect to see higher prices on USD JPY, and I was expecting to see 160 again, and even 162. So these levels for me are very risky to buy from. Why? Because whenever it reaches above 160, the Japanese government might intervene and might drop it to what, like 156 again. But it's also too risky for me to sell from here because you never know when they're going to intervene, right? So they never announce that, yeah, guys, we're going to intervene. That never happens. So you might be selling from here, betting on the intervention of the Japanese government, and you might not get it for another 2 months, and you'll be stuck in a short position against the trend. So that's why I wouldn't be bothered with USD JPY swing. But if I get like very short scalps or very intraday, like very short intraday trades, I would go for them. But other than that, I wouldn't be bothering myself with the long term view on USD JPY. Any chance to more fall? You mean the gold? What do you mean, Mr. Professor? What are you asking about? Good morning, Mr. Abi. On June 16, there's also Bank of Japan meetings. Yeah, that week is going to be like packed with central banks meetings, but the most important one of the month or even the year, I think, is going to be the Fed meeting that is going to be held on 16th and 17th, and the press conference and the decision is going to be on the 17th. So yeah, we need to pay very close attention to that. Yeah, Mr. Professor, you're asking about Nasdaq. Yeah, I think it has more room to drop. As I said, the optimal area or level to retest is going to be 26,000. So another 3,000 pips from here. Yeah. Yeah, so guys, I think that's it for today. Thank you everyone for watching. Thank you for your questions. Thank you for your time. I enjoyed this. I hope you enjoyed it. And I believe we are going to see very, very nice opportunities very soon in the markets. Like, I think it's time to start and like plan long-term trades and swing trades. It's this time of the year that we start to prepare for the monster trades, so to speak. Okay. Thank you very much for watching. Thank you for tuning in, and I'll see you on the next one, guys. Take care of yourselves, and bye bye.